Hi, Matt McAleer, President, Director of Private Wealth, Cumberland Advisors, August 9th. Nice volatile week. What do I mean when I say nice volatile week? Well, look back to last Friday. What were we talking about? Trying to focus on names that stayed and remained higher than their April pullback. That shows there's more demand today for those sectors, those industries, those stocks. Monday, real opportunity. Unfortunately, I was playing that opportunity to think we were going to see a little bit more this week. And the week was bumpy, but we really didn't get any of that money to work. Next week's another week. We certainly haven't shown anything from a breakout stage, but what could we have done differently? I'll tell you one thing. And this is a little bit second level for some of our listeners, but I think our clients would like to hear about what we try to analyze intraday. So last Sunday into the Monday open, as you've read in countless spots, there was some real problems in Japan with the yen really strengthening against the dollar. That flipped a very speculative short position on its head. The only way to hedge overnight or to get liquidity for those that are caught short and need liquidity is in a liquid market like the U.S. futures market. So by the time we rolled around 6 a.m., 6:30, 7 a.m., that S&P futures was showing a down 4.5, down 5. I saw it spike to down 6. I said, oh, we've got some action here. The reality is, when the cash market opened at 9:30, the market, it pulled down hard, but it ran out of downward momentum, down 3.5. What that told me, should have told me a little quicker, is that so much of that down 4.5, 5, 5.5, 6 in the futures market was artificial. It wasn't real cash selling. So the market ended up down about 3% on the day, and it's been back and forth, but finished the week strong. We'll still continue to look to put those pieces of cash to work, but I was very pleased with how our positions traded. Remember, we tried to lean on industrials throughout the last 6, 8, 10 months. Outside of the Monday flash drawdown, industrials traded very well, and I think some of that was the encouraging news that continued to come out on the economy. We can talk about higher unemployment, we can talk about hours worked, we can talk about all the economic indicators, but the reality is those numbers are at level, reasonable areas for this economy to work well. So, where are we? Well, we're looking at trying to put a little bit of cash to work on pullbacks. Where we're long, we're pleased. In terms of our U.S. core and U.S. ETF, we've bolstered the growth side over the last 2-3 weeks into the pullback. Over in tactical, haven't done too much. What we own's working. Berkshire's trading solidly. Microsoft had a rebound this week in terms of some of our holdings in ETFs. Good action. So again, we won't jump out to a new strategic view on our strategies. We'll just try to feather in some cash. Enjoy the weekend. We're going to shoot over to the Moose now.
Thanks, Matt. We're talking to you on Thursday afternoon because I'm going to be off tomorrow, but we wanted to give you a bond update for this week. A little more normalcy in the bond market after last week's craziness. We brought along a little chart to show you where both the muni market and the treasury market were on Tuesday a week ago, right before Jay Powell spoke the next day with the Fed meeting, where they kept rates unchanged, but gave kind of a dovish tone that they would be cutting most likely, or would like to cut at a September meeting. That, of course, was followed up by a jobs number on Friday, which was a big miss, and it was off to the races with yields coming down. You can see here the close of Friday's yields, how munis and anything else could not keep up with the drop in treasuries. And this week, a little bit of a backing up. Why? Because markets overshoot. They always do. And this was no different this time. The fact that 10-year bond got all the way down almost to a 365 intraday before backing up, and as we sit here now, it's just a tad below 4%. Our viewpoint is that we'll probably see the 10-year bond trade between 4.25 and 375. That's probably a range. Certainly, as the Fed moves forward and we see what kind of rate cuts we do get, that will form a lot of the arguments in the bond market. We have certainly seen the yield curve start to disinvert. In other words, the big inversion that we've seen gone on has really almost gone back to zero if you're talking about between 2-year bonds and 10-year bonds. It is still very inverted if you're talking about 3-month paper, which really trades off of the Fed funds, which is still up in that 5.25 range, and the 10-year bond, which is at 4. So that is still negative. That will eventually disinvert as well, and the yield curve will turn positive. Usually that happens in an economy that's slowing. And certainly the market last week took the cue that, boy, the economy's slowing when they saw the job numbers. We will know more next week. We're going to have inflation numbers. That will certainly kind of be the base case for the Fed's decision. We hope everyone has a really great weekend, and we will talk to you next week.
Thanks for joining us. The Moose is on his own with the video next week because I'll be up in Saratoga Springs, the summer paradise. As I've said the last few years, if any of our friends or clients are up in Saratoga Springs next weekend, want to have coffee, want to have lunch, give me a ring. Enjoy the weekend. See you in 2 weeks.